Well, hey everyone, thank you for joining us today. I guess it's our job in the next 60 minutes to introduce you to something that will hopefully transform the way that you think about your business. My name is Colman Swisher. I'm a certified exit planner and the co-founder of Boldr Futures. In my former career, I was a VP of strategy and CIO for the largest radiopharmaceutical logistics company in the US. We shipped a lot of CAT scans, PET scans, and pharmaceuticals all over the US. So there, I kind of had two stages to my career. In the first one, I was focused on boosting our valuation from 4 to 20 million in 3 years. I did that by focusing on value creation, not just revenue growth. While our value increased 5x, we only doubled our revenue in that time. So it's kind of the magic of focusing on value, revenue, and profit follow that, and they're less important to valuation. My second act, I drove our buy and build strategy. So I integrated the companies that we acquired through that process. I developed a 90-day acquisition integration playbook. In that second act, we quadrupled our revenue. When I started, we were about 10 million in revenue. When I exited, we were about 100 million in revenue. I've been in the thick of scaling, integrating, and preparing businesses in the logistics space for my whole career. And I would say to encapsulate everything that I learned, I would use the words of Peter Drucker, what gets measured gets managed. And to piggyback off of that, my underlying philosophy is that the number one most important metric that every business owner needs to make a focus and a priority above all else is value, company value, not revenue, not profit. Those are important. You need to track them. But by making value the number one metric that you're driving towards, that's where transformation happens. Also with us on the call is my esteemed business partner and big brain, Jeremy Nulik. He's also a co-founder at Boldr Futures. Jeremy is a certified futurist and strategic foresight expert. I mean, he's all about turning uncertainty into advantage. So he's really fun to have as a business partner for that reason. Before Boldr Futures, Jeremy worked as a futurist at Big Wide Sky, where he crafted transformation strategies for Fortune 500 companies like Bayer and Enterprise Mobility. He's also a guest lecturer at St. Louis University and a sought-after speaker on how vision shapes valuation. So Jeremy is the guy who sees the trends shaping our future, and he sees them before everybody else. Within that context, he helps business owners see what's around the corner and helps them craft a preferred vision of their future. So if you ask Jeremy, I would say that his motto is that vision drives value, valuation follows vision, and I couldn't agree more. So together we built something unique. We are calling it Boldr Futures. We are where we merge our two distinct backgrounds, our two distinct methodologies, strategic foresight and value acceleration, into Boldr Futures. And we exist to give business owners tools, methodologies that help them legacy to engineer a legacy and exit a business that they want. We like to see business owners stay in control of their business, grow it their way, and build a business that's ready for anything. So whether you want to exit your business eventually or not exit at all, we want your business to create generational wealth. So anyways, that's the intro. Thanks for joining us today. We're really excited about what we put together. We hope you get a lot out of it. And I'm going to turn it over to Mr. Jeremy Nulik.
Thank you, Coleman. Thank you for that introduction. I'll try to reduce the big brain aspect of it. Hey, as we get started today, what we've designed, I hope, is a serotonin boost to your Thursday. We're going to run this for the next 52 minutes. This is a format that Coleman and I have worked on that typically we run for a couple hours. So we've tried to truncate and follow some method for how it is we can fit this into a 1 hour conversation and a simulation of some of the work that we do, and hopefully it inspires you. So we're going to go on to a journey into the future. We're going to map some key valuation building decisions. We're going to talk about this method, explore that it's something that most traditional consultants and certainly no private equity firm can do for you. And what you'll have as a takeaway also is a 90-day starter on how you can get going based on this methodology. But before we even dig into any of that, I first actually want to take us from our present day to March 15th, 2035. So the Ides of March, 2035, great day to pick. And you're in Des Moines, Iowa, and you're sitting in a conference room with Tom Rodriguez. Tom is the second generation of Heartland Express, and he's about to sign the deal of a lifetime. He's the second generation, like I said, of Heartland. His father, who's a former truck driver, started the company in 1986 with just one truck. It was parked out on the gravel next to Tom's house as he was growing up. And right now, his mind is flooded with those kinds of memories because he's surrounded by family, friends, of which apparently you're a part, and a lifetime of supporters. The reason that there's celebration in the air is that this is the day that he's signing a really big deal. He's looking at a $76 million acquisition by a Fortune 500 3PL. And Tom, in the time that he spent leading Heartland Express, was able to achieve a 10x EBITDA multiple, which is above the industry standard of, which is normally 5 to 7 for a trucking company. And if you take a look and you dig into those numbers, maybe a little bit farther, he's at about a 38 million in annual revenue. He's up from the 12 million in 2025. So 10 years ago, he was at 12 million and he was able to increase revenue. He's at a 7.6 million EBITDA with the industry leading 20% margins. And it's a 98% contract renewal on specialized services. And he doesn't have any concentration risk to his clients, which is why it is he was able to get this deal. And so what's really remarkable about all of this, of course, is that it wasn't luck. This is a logistics company that is not necessarily like in a hot market. This is a traditional freight hauler that made three very smart bets on some emerging trends between 2025 and 2035. And today, what we're going to do is I'm going to outline for you what some of those bets were, but we're actually together going to build the story of how he went from 2025 to 2035 and what specifics he engaged in, what partnerships he engaged in. Because everything I'm about to share with you is based on trends that are happening right now. And so I should give you a heads up. I probably should have done this maybe 3 to 5 minutes ago. There will be a participatory part of this webinar. So I hope you guys can jump in. The more you can share, of course, the best. It's no expectation, but we'd love to get some insights from you. But just to take this back a little bit further, if we go back to good old 2025, Tom had a typical regional carrier that was facing a crisis. Tom knew that he'd need to exit within the next 10 years or so, and neither of his kids were really interested in taking over the business. He was at 12 million in revenue. That was down from their peak in 2021 that they had at about 14 million. They focused on manufacturers, ag products, and food. In 2025, Heartland looked like a lot of other regional carriers. When it was founded in 1986, Tom took over from his father in 97. By 2025, they had 45 tractors, 120 trailers. They were serving the Midwest corridor, Iowa, Illinois, Wisconsin, Minnesota. They offered competitive pricing, but there wasn't any real differentiation. And Tom had a minimal tech, just tech is needed. So he had a basic TMS and some manual dispatch, but he was really facing some very real challenges on his horizon. And he wasn't alone in facing those challenges. You know, there was a freight recession that he had just on the back end of in 2025. His operational costs, though, were up 22% in just a couple of years. He had over-reliance on three of his main customers. So 30% of his revenue was concentrated, and that created some dependency on them. He had commoditized services, and there was a technology gap. There was no real differentiation that he could offer outside of just feeling like he was consistently getting beat up on price. And more of his customers were demanding more precision in precisely what the logistics looked like and where things were and how he could offer real-time tracking. And so Tom's aha moment came right around 2025. And it could have been inspired by some webinar by two bald guys sometime in the late summer. In addition to that webinar, Tom was sitting with a customer who's a packaging manufacturer. And the customer says that they need deliveries with 2-hour windows to get our just-in-time production up and running. And he wanted to know if Tom would be willing to guarantee that. So, of course, in the meeting, Tom says, well, no, I can't do that. But the customer then stops Tom before he leaves the room. And he says, hey, well, you know, we've always liked working with you, and we'd be willing to pay a premium for that level of precision. And so that night, Tom sat with it, and he had his Jerry Maguire sort of moment, and he realized that the industry is changing fundamentally, and that he could either lead and lean into that change, or he could wait. He could just try to wait this out. And so while his competitors were fighting over shrinking freight margins, Tom saw this opportunity to take advantage of some trends that were on the horizon that he'd been ignoring, but these manufacturers desperately needed to execute on. And so the first bet, he made three bets, like I said. And so this outlines, by the way, just what happened over the course of the next 10 years. The first bet that he made is that Tom realized that manufacturers are moving to these hyper lean inventory models. Just in time manufacturing wasn't optional, it was really survival, it was table stakes. And his customer base of these Midwest manufacturers, they were already implementing lean production. Ag equipment manufacturers that were 20% of Heartland's business were under pressure to reduce their inventory carrying costs. And so Tom made the investments necessary to provide precision logistics, and he invested in real-time tracking technology and predictive routing systems. And the key insight that he came to just after a couple of years is that the information about the package was just as valuable as the package itself. And so when he saw that he could provide this level of precision, Tom took a look at maybe some other markets that could use this kind of precision. And it turns out that Des Moines is within 300 miles of some major pharmaceutical distribution centers. The medicines that require cold storage, he saw in his trend data that rising from 26% in 2017 to 35% by 2022. And projections out from there showed that approximately half of all new medicines in the next 5 years would need cold storage. And so at 99.9% temperature compliance wasn't nice to have. This was life or death for a lot of folks. And so through his natural network, Tom established connections with those pharma distributors, and he made the investments in equipment and compliance necessary to take advantage of the premium per mile pricing that you see there. Then once he was able to do that, Tom took a look again after a couple of years, and he saw that the global on-demand warehousing market was going to reach 26.19 billion by 2030. And it's just growing at a really rapid annual growth rate from 2024 to 2030. This pay-as-you-go approach was ideal for people who had seasonal demands, which were, again, part of Tom's customer profiles. So he realized he had all the customer relationships necessary and that manufacturers would need flexible storage for just-in-time delivery. And the Midwest location was ideal for regional distribution. He could partner with some existing warehouse operators rather than build it from scratch. So Tom began to offer warehouse and inventory management, cross-docking, kitting services, and it created a monthly recurring revenue that was separate from what he would normally just get on freight. So the purpose of walking through all this was this compound impact that this had, and each service built on the other one. You know, just-in-time precision enabled pharmaceutical contracts, the pharmaceutical compliance opened inventory opportunities, and that subscription model he was able to take advantage of in warehouse as a service, created a recurring revenue and a more complete solution. So I hope we ran through that pretty rapidly, but what we're going to do is actually dig in on each one of these. So your mission is to reverse engineer what Heartland's strategic journey looked like. Heartland went from 12 million to 32 million, went from a 5x common EBITDA multiple to a 10x. We talked about some of the stages in an outline, but we're going to fill in that outline with what specific investments and bets within those would Tom need to make. So we're going to take a look at that 10-year transformation. I want your insights on what you think took place. And what I want you to do when you take a look at this is to go ahead and think about your own customers' emerging needs as you answer them. So allow for this exercise to have you pause and reflect on what kind of emerging needs you see even in your own customer base. So we're going to put up 3 categories, and Colman, if you'd be willing to drop the link for this in the chat. I'm going to switch over to this lovely Mentimeter, and we are going to populate it with some of the answers on his journey.
I believe that is the live link. I'm going to test it out right now for myself.
Excellent. Great. So yeah, the question on the table is, how did Heartland Express get here? How did we go from 12 million to 32 million in revenue within those specific bets that he made? So the first question is, what customer challenges, partnerships, investments would be tied to just-in-time logistics? If this is where Tom started that journey, but you know, what new partnerships would he have to engage in? What challenges is he addressing? What investments would he need to be making? Assuming that he's still serving that same customer base that he had back in 2025. This is how he started that journey. What kinds of investments would he need to start making? You can think about even regulatory compliance. You can think about technology. You can think about service innovations. Any of those are valid responses, right? So we have data visibility portals, real-time data, a lot of technology investment in automation and integration, frictionless experiences. He would have org chart challenges for sure. That's a good one to bring up. Rethinking, who in his organization could actually help him to enable that strategy. Data is coming up quite a bit. Would need a solid TMS. That minimal TMS wouldn't do the trick when it comes to just-in-time logistics. A customer service software as a service is really interesting. A commit to differentiation is a really good point. That's something that would be like a first domino, right?
And I think I had you
Mike is
unmuted.
Yeah, you unmuted me. You're really going to need somebody to understand your unit economics and how to help you price this and how to drive margin on this. You could do this and lose your shirt.
Right. So he would have to find someone that he'd either add to an advisory board, or you'd have to bring somebody in to do the projection on what this would really take. Is that what you're saying? Oh, you went back on mute. There you go.
Yeah, no, yeah, absolutely. You're going to need that expertise to get through this.
It's a really good point. Thank you, Dan. Any other people who want to volunteer or say more about any of your answers? Particularly anybody who answered with data. Curious to hear what you might have to say. Silverberg.
Doesn't want to unmute you.
Yeah, you're unmuted.
I
There you
mean,
go.
obviously, I've had the unique experience of scaling a logistics company, so I guess I kind of cheated on the homework assignment here. But the data component, I think, is what you asked, Jeremy. There's no way that they achieved the success that they did without having real-time visibility, whether it's with Power BI or any other kind of platform. But the data component being real-time, you just can't make decisions that are going to help you scale. And this is across all departments, so it kind of ties back to the org chart as well. You can't make decisions on what is sustainable for your dispatch team, for instance. How many people do you need? Well, without having any kind of analytics or metrics behind call volume, response, ticket resolution, then you look at like even the finance component of, okay, like we don't make any money on this lane when we run it this way, and so on and so forth. I mean, a lot of people on here have touched on the data component, but the real-time visibility of that data can't be overstated. And I think that this particular company probably, to achieve the success that they had, doubled down on that importance well ahead of their competitors, which is what got them to where they ultimately ended up.
That's a good point, because you're right. It's not solely the data, but the story that it tells with the what are the dominoes? What are the critical numbers that need to be measured that are the predictive component of, hey, when this happens, or, something that can make sense of, and you begin measuring what are those critical numbers exactly. Eric.
I think Matt might have sort of touched on this, but the thing that occurred to me specifically with that number 3, and then I think applies to all of these, is the visibility of data to the client. With warehouse as a service, for example, you can tell me that you have my stuff. Or with cold chain, you can tell me that it stayed within whatever criteria along the way, along the supply chain or whatever else. But if I can get some sort of updates through a web interface or whatever it is, then I think it helps to calm any anxiety or questions as we're going through the process to see, oh no, here's where my stuff is, or here's how it's being taken care of. And I think you would have visibility of data needs all through this process that would give clients that confidence that they made the right decision to go with you.
Right. Right. So you're saying along with the data, it's what is the interface that the customer has with
Yep.
and the real time component of it, and that would be a critical part of the investment that would be tied to it for sure.
Yep, you got it.
Expanding on data obviously being key, AI is going to have to be a big component and a significant investment to achieve the just-in-time targets, no doubt.
Somebody had to come in and do the AI thing. I appreciate you doing that. Well, when it comes to bet number 2, so bet number 2 was on pharma cold chain, building on what investments, partnerships, challenges would be tied to that first one, building on that first one, enabling a strategy that created an opportunity in pharma cold chain. What are the additional challenges, partnerships, investments that would need to be critical for this bet? So assuming that you were successful and you met those challenges in the first one, and you developed those partnerships and you made those investments in data and AI, like we've said, using a Power BI, like Matt had indicated, being able to understand that the information around the package was just as important as the package itself. How can you build on that to enable a pharma cold chain offering and make it a core part of what you're doing as Heartland Express? Data and visibility, right? Hardware and equipment, right? You would need to install refrigeration equipment, right? It's going to be a key part of your investment. Excellent. Capital partners is interesting. Like you'd need to seek some additional financing is what you're saying. You'd need a capital injection. If the person who said that is willing to come off mute, I'd love to hear about that one. IoT chain of custody is great. Mr. Holtman.
Yeah, you nailed it. Obviously, a lot of infrastructure and technology investment needing to be made. So I would imagine there's going to be some capital needs. So I think that would probably be a key partnership and investment that would be needed, and maybe hopefully not a challenge, but could be.
Sure.
Right.
Thank
Super
you.
good point. I mean, it's got to remain temperature controlled, which vehicles have to be equipped with that equipment. Warehouses have to be equipped with it. You know, there's IoT devices that are tracking temperature and location and all the other metadata. Yeah, that's definitely, that stuff ain't free.
Right. Yeah, and depending on the size of his fleet, that scales that up and down, and yeah, where he's at in terms of the number of assets. Exactly. Risk mitigation insurance. It's a really good point. Compliance and paperwork. That's a really good one, right? Like FDA, ISO, all of the compliance and regulatory vehicles that are out there. Does anybody want to say more about compliance?
Yeah, that was mine, actually.
Oh, nice work, Colman.
Yeah. It just introduces a lot of regulatory frameworks you have to play within, right? On the pharma side, on the temp controlled side, if they're crossing any borders for sure. And when there's paperwork, there's the potential for delays, there's potential for errors. If I had more characters that I could have typed with, I would have said something like digitization of paperwork, maybe smart contracts that when an event happens, paperwork is automatically generated because the event happened, all the compliance aspects of that shipment moving have already been validated. So, you know, paperwork, compliance, regulatory stuff, it introduces a lot of potential bottlenecks that are real world challenges.
Right. Right. So assuming that Tom built this and was able to achieve pharma cold chain as a key part of his customer profile, customer challenges, partnerships, investments. Oh, here we go. Are tied to warehouse as a service. And while you're thinking about that, and while you're just vociferating, your facilitator is going to update a slide. This is something that AI did not fix. You know, I mean, it can do a lot of things. So assuming we have this just in time, opened up a new set of opportunities. And through that, we're able to see the data, track packages, understand things better, we're able to achieve a new level of premium with our customers, shifting over and seeing that within 300 miles, there's all of these pharma distributors, pharma cold chain needs. If you're able to achieve all of those, and then you took a look at warehousing as a service, because there was an opportunity there with the lean manufacturing and with all of the needs that had to do with kitting services. I know just offering a different wraparound service. It also created a subscription service for your company. What would be the challenges, the partnerships, the investments that would be tied to warehousing as a service? Oh, that's interesting. No more warehouse staff, robotics and automation, right? You'd need a warehousing management system, software as a service, predictive inventory need, no more on-prem storage. That's interesting. So I think the same person who answered with no more warehouse staff might have been the person to say no more on-prem storage. Is there anything more whoever had those answers would like to add to them? There you go, Eric.
As a customer, I'm less likely to need to own as much property, physical space. And then what does that change? It changes the type of insurance that I need. I mean, I'm sure I still need some form of warehousing, commodity, whatever insurance. You have insurance as well, warehousing for me, and any number of other things, which maybe, depending on the focus of my business, if I'm your client, that might allow me to actually focus on what I view as my real job.
Right. So it no longer becomes a core part of what you're saying. You're kind of like offloading some of that to whatever partner you bring in.
Yeah, maybe another way of putting it is that you're allowing me to focus on what I want to specialize in and have be my unique differentiator.
Right on. Anyone else who has more that they'd like to add to this deep customer ERP intimacy? I think was interesting. Dan.
Yeah, that was me. But yeah, I think you're going to really need to understand what the end customer, like where their value need is in their entire enterprise, in the entire supply chain, because you're probably working with customers at multiple points in their supply chain here, both inbound and outbound. And so you're going to have deep visibility and intimacy with how they plan that.
Right. So a deep integration with even those customers on the totality of their supply chain, a deeper understanding of it is what you're saying.
Yeah. Before there's that ability to do that interconnect, that deep understanding of where is the value. Is it on inbound? Is it on outbound? Is it on, holding inventory? Is it, what is it, where is the greatest value for them?
Right. Any other thoughts, feelings, or dramatic interludes about warehousing as a service?
I'm just glad I'm not shining you guys out.
Right. So, I mean, the purpose of running through all of this, and it's intended to be, like I said, the sort of like the cooking show version of what a deeper dive into any of this might look like. But the purpose is to start to pull apart what would be involved, like what would be the stages necessary to achieve any of these as outcomes. So if this was part of a vision, as you backcast, as you take a look back through what it is that you're doing, you can begin to see what are the elements that would need to be in place to tip things in that direction. So what we'd like to do is actually walk through the timeline using some of the elements of what you guys answered to talk about how it is that Heartland Express was able to achieve what they were able to achieve by 2035. Have you ever watched those cooking shows and they show how all the ingredients get put together and then they show you the baked product? So we did go ahead, and Colman and I had conversations on what would it take to achieve this? What would be the dominoes involved? Several of you had mentioned customer visibility needs. That would be one of the first things that you'd have to take a look at if you were going to engage in just in time. So that's exactly what Heartland tackled first. They created GPS tracking upgrades, driver training programs, delivery confirmation systems just right away. Then they moved to driver training for that precision delivery. And so we talked about having insights that were predictable. That was what Mr. Silverberg had indicated. So those insights are predictable, they're not reactive, right? So they specialized training for that 2-hour delivery window. and they developed then a customer portal for real-time visibility. And this enabled that premium service tier that they launched by 2028. So they had a 35% rate premium over their standard freight, and they were able to sign 8 new just-in-time manufacturing contracts by the end of 2028. And then if you move to from 2028 to 2031, Mr. Swisher was good enough to talk about those certification processes that would need to be in place for cold chain. And so they developed those documentation systems, specialized training programs, validation studies, and compliance audits. They took a look at the specialized equipment that they would need. And luckily, Tom's company wasn't large enough that he had, just a smaller fleet of trucks. So he could fit them with the reefer equipment necessary, the backup power systems, the real-time alerts, the insurance coverage for that pharmaceutical cargo. And so that results in the compliance being achieved. So they had farmer-client development that they engaged in, and they had a 99.9% temperature compliance that they were able to achieve. And then by 2031 to 2035, they focused on warehouse as a service. And this was the perfect execution of the whole concept of partnerships over acquisitions, like Mr. Pradum had talked about, with being able to develop those key partnerships, those with warehouse operators, is what led to them being able to engage in this strategy. And then they were able to integrate a logistics platform, the WMS integration, like you guys had talked about, customer portals, having that real-time customer visibility, a real-time visibility, end-to-end supply chain. And this enabled then, by the end of 2035, those subscription revenues. So you had a monthly service contract, and that created predictable cash flow for you. And that results in a 78% customer retention rate that has a recurring revenue stream. And so the point of walking through some of these elements is that the end result that you get to is that, at least when we did our back of the napkin rough order magnitude estimation of what the investment would look like if that came from capital sources or it didn't, the investment looks something like $2.5 million or so, and that creates a $71 million value creation by 2035. And that is the power of having a strategic vision. So over those 10 years, having that $2.5 million investment results in a 3,000% ROI breakdown on your strategic investments. And that's not from just luck, that's from the market timing and being deliberate about strategic choices. Of course, Tom, having received some consulting from Boldr Futures, was able to make deliberate choices, intentional choices about where those strategic priorities needed to be. The just-in-time precision led to the pharma compliance, and that enabled more integrated solutions. Each capability enhances the next one. And so if you take a look at this and you break it down, it, again, not luck. This is fundamentally how those 3 bets enhance 4 value components. And this is our Boldr Futures legacy multiplier developed by Mr. Colman Swisher. And so what they accomplished maps perfectly to that legacy multiplier. So that legacy multiplier consists of growth capacity, your ability to scale, your risk resilience, your strategic clarity, and your operational independence. So it breaks down into each component of these. Each of those strategic choices break down into each component of this legacy multiplier. And so with something like just-in-time precision, that creates a barrier to entry for those competitors. You had to have made an investment in delivery compliance, and that takes years to build that system and expertise. People are going to be less likely to try to jump into that. The pharmaceutical compliance became a recurring revenue, certification revenue. The warehousing services expanded into storage and fulfillment. And so the result of that is what we projected to be a 15% annual growth revenue versus the 2 to 3% that you normally would get. Strategic clarity, just-in-time delivers guarantees that created some switching cost barriers. Similar to what I even talked about in growth capacity, you create a moat around that capability. FDA and other certifications also became regulatory moats. If you want to jump into trying to serve that market, you have to have already made these investments. So the switching is less likely for your customer base. You have integrated solutions that meant that you had a comprehensive supply chain ownership. So you had visibility over the entire supply chain, and you weren't just seen as a trucking company anymore. The result is that you reduce your customer concentration. You're able to wrap around the entirety of the supply chain. You reduce your concentration. Operational independence. You've got automated delivery precision monitoring, so it's constantly going. This is a system that works. You have predictive maintenance systems, so you're able to see when it is you're going to need to service. You have alerts that can come up. You have a digital warehouse management integration. And so the result essentially is that the business can operate without the owner. The business can operate without needing Tom's influence. And then risk resilience, you have manufacturing precision meant that you had premium contract terms that had penalties attached to them, and that's what people would agree to. And so healthcare demand is also a recession-resistant revenue source for you. People, it turns out, still get sick no matter what is happening in the economy. So people are always needing that pharma cold chain that you've invested in. Flexible warehouse provided recurring revenue streams, and that resulted in a 98% contract renewal versus the 65% that is the industry average. This is a rosy picture, I'll admit. Not every bet pays off. That is just part of working in business. But for the purposes of a simulation, a 1 hour virtual exercise, the concept here was to tie what investments were made, what were the stage gates involved in those investments, and then how does that translate, and how can you make a priority the elements of that strategy that are valuation building. And when you can make sense of why that investment offers you an ability to say, this is why that investment makes sense. Each of these has a compounding effect on the previous one. So each investment amplified the others. That creates bundles that customers couldn't replicate either for themselves, and they couldn't find elsewhere. They couldn't find another partner that would work with them. And so if you take a look at traditional freight in terms of EBITDA that is common, you have a 4 to 6x EBITDA in our current market conditions. Specialized logistics has 8 to 12x EBITDA. Regulatory compliance companies, which is the category that Tom would have been a candidate for, or is a candidate for, I suppose, if we're still in 2035, that's a 10 to 15x EBITDA. And so what drives that premium valuation is the regulatory moat reduces your competition. It creates a barrier to entry for all of your other competitors. Sticky services generate that predictable cash flow and the high switching cost. The premium margin means that you have quality earnings over a commodity pricing. So you're not just in situations where you're constantly getting beat up on price and trying to optimize for a system that is being commoditized. And so the way that the buyer, when they're approaching Tom, the way that they would see this is that Heartland, we're not buying a trucking company. We're buying specialized expertise, risk mitigation capability, and supply chain optimization that happen to include, it just so happens to include freight movement. But what they're really buying is an entire system that is built. So our research confirms that these EBITDA marks of 5 to 8x EBITDA for most privately held firms are in place, and the companies that with specialized services like the one that Tom built, they command a higher multiple. And so the question that emerges, of course, is what is your emerging opportunity that's on the horizon that's just resting with your current clients? Before I even get into that, though, if this seems too pie in the sky or too rosy of a picture, if we go back in time about 10 years, there is, a firm out there, and you may have heard of them. They're called the Quiet Logistics Company, which is a clever name. They were founded in 2009 by two men who had a background in retail logistics, and they made a big bet when it came to adopting robotics. They partnered with Kiva Warehouse Robotics for a number of years, but when Amazon, of course, came along and required Kiva, they believed so much in their bet that they built their own robotic system. So in 2015, they created Locust Robotics, and that was the first automation pioneer in logistics. And by 2021, despite how people may feel about, what's her name? What's the woman's name who's in the American Eagle commercials? Sydney Sweeney. Yeah, they were able in 2021 to offer a premium exit of $350 million acquisition by American Eagle Outfitters. And at least the press release from Quiet Logistics indicates that they're remaining independent, even though they were acquired by American Eagle. So again, the question on the table for you in the 7 minutes we have left today is taking a look at this. And I think that one of the key parts that we want you to take with you is that if you took a look at your industry trade shows and you take a look at all of the education events that are at those trade shows, there's no lack of people to talk to you about trends. And there's no lack of people who talk about projections. And there's no lack of people, certainly, at least 40% of the content, if not more, is about AI, right? And what we want to encourage with you is that the inspiration for a vision for your company need not be something that you export the responsibility for to consultants or a bunch of people who tell you what the trends are. The seeds of what could inspire your vision are actually in your customer's pain. Getting to know them and getting to know what kind of pain that they're experiencing, what's keeping them up at night that's logistics related, is that's where you can look for problems that they'd pay a premium to solve. And so if you took the next 30 days and you just grabbed a couple of those customers and you were able to talk to them about what kind of pain are they in and what's logistics related, you can begin to create the seeds of a unique vision of the future that then, who knows, maybe you can develop a 2035 vision and take a backcasting approach to a conversation with your leadership team. That would allow for you to have a gap analysis. What's the gap between what they need now and what we could reasonably provide? So are there partnerships? Is there training? How can we design a pilot? How can we create something in the next 90 days that would allow us to find one emerging need that we can address and create a small scale pilot, an MVP of what it would look like, and you could begin to measure success. There are emerging trends, of course, to take a look at. So there's no lack of emerging trends on the horizon that are impacting logistics and supply chain between just-in-time precision. The compliance and regulatory requirement environment is another place to look at for an opportunity. Technology integration, like we've covered a lot of today, and sustainability. The point of this is to create a vision-informed valuation building strategy. You can start where you are and use your customer success relationships to talk about solving real problems and address those pain points. And that can be the place where you start to create a premium to fix those problems for them. And so you can begin this process by creating that in your organization, creating those switching costs, creating a situation where you would be the go-to partner for this. So our call to action is to take a look at what you're ready to take on. What commitment are you willing to make today? So the trucking industry is going to continue its march out of the freight recession, and the expectations shouldn't be a quick turnaround that you could make. You have to focus on your efficiency, leveraging new technology, and that's the environment where your strategic differentiation becomes most valuable. So you can position yourself as indispensable for that high value level of service that customers pay a premium for. And our simulation today is intended to show that you can create an extraordinary valuation that doesn't require a revolutionary change. You can begin to create those incremental changes in your organization toward a bold vision of the future. And every logistics company is looking at changing hands at some point. The question isn't whether or not you're going to do that. The question is if you're going to get the full value for what you've created, or if you're going to leave millions on the table. The companies that use this time to build are going to be irreplaceable in terms of their capabilities that they can create more stronger, more valuable, and positioned for generational wealth. Just to hammer this point home, some of you on the call might be receiving those emails from private equity firms, and this is something that PE is not going to do for you. They're not going to help you to do this, and honestly, a lot of traditional consulting firms aren't going to do this for you. The investment that a lot of those folks would make on behalf of your company is tied to value extraction. So that is how they're motivated. So no one can tell you what the best version of your company looks like in 10 years except you. And you're actually the folks who are shaping what reality looks like, and not people who tell you what the trend lines look like. So we hope that you activate starting today to develop a bold path and evaluation building strategy, and that what you can do is facilitate that methodology that we outlined, and you'll receive a copy of this at the end of the presentation so you can take a deeper dive into what's involved. And so we have 4 foundations starter packages that are designed specifically for logistics companies that we're offering just to the folks who've come to this presentation. And so right now we're offering 4 of those that are designed just for you, and a season of strategic planning is just around the corner. So we hope that this was valuable for you today. We're going to actually end on time and respect your time, and we appreciate you coming. You could look forward to a follow-up from us that has an encapsulation of everything we covered today. We hope you had a really good time. I know that Colman and I may have just had a good time at your expense, but we hope it was really useful to you and spending time thinking about how you can begin a bold vision strategy toward your valuation. Thank you for the claps, Mr. Holtman. Appreciate
And
it.
thank you for the participation today, you guys. Thank you.
Yes, thanks for jumping in.